Intech Managing Director Anthony Serhan recently prepared a report for the Association of Super Funds of Australia. In the report, it was found that super returns had fallen into negative territory 7 times in the past 50 years. Today we've got Anthony Serhan with us to discuss the report. Thanks for joining me today, Anthony.
Thanks, Julian.
Anthony, what was the purpose of the report that you prepared?
The ASFA study is really about putting returns from superannuation funds into a time capsule, which we can open up every year to see how things have gone. I guess there's lots of material prepared about how equity markets have gone. This is specifically targeted at trying to identify the typical superannuation fund and what sort of returns it has achieved. And it's really about taking a step back and looking at the long term.
Long-term returns were found to be positive even with growth assets. Did it make a difference when investors entered into the investment cycle with their super?
Yeah, it does. The timing of when you're actually coming into that space does make a really big difference. For example, the difference between the bottom and top performing year is like 56%. Even over 10 years, that might come down to 20-odd%. 15 years, the range might be 5%. Over 30 years, the range has been between 2% between the worst and the best performing. So clearly, when you come into that period, will make a big impact on what you achieve in the short to medium term. But what this study does show is the longer you're invested for, the less that timing makes. And for a superannuation investor who's putting a little bit of money in every year, the timing is less significant. Clearly, at the other end of the scale, when you do have a large amount built up and you're looking to use that for your retirement, then you really do need to sit down and think about, well, how long am I going to put this money to work for and what are the range of outcomes? And that's clearly where planning and thought goes into how you're going to work.
When super fund returns have fallen into negative territory, how long has it typically persisted? And when it's recovered, has it recovered suddenly or in a gradual way?
Yeah, no, it's a great question. Technically, when you look at our study, this is the first time that we've had 2 consecutive years of negative returns. So 30 June 2008 and 30 June 2009. But if you look back through the history, there have been other periods where it's been pretty close. So, 2002, 2003, once again, one of those years was negative, one of them was 0.1%. So, let's call it 2 years of negative return. What followed? 4 years of solid double-digit returns being put into people's accounts. Go back to the 1973-74 period. 1974 was, in fact, the worst year, over minus 14% in terms of a return. 1973 was 0.1%. Once again, 2 pretty ordinary years. Those losses were recovered within the space of 2 years. It's clear when you look at the cycle, there's periods of strong returns and weak returns. You go back to the mid-1980s, had some of the highest returning years, followed clearly by some very low returns, the 87 stock market crash. So that cycle is quite clear. Strong, followed by weak, and then it just speaks to the volatility of the equity markets, which make up a large chunk of a superannuation fund.
We constantly hear that 2008 means that we've hit a new normal for super returns. Does that mean that past performance is no longer relevant?
No, it doesn't mean it'll no longer be relevant. I think, the old adage that, past returns, no guarantee of future returns continues to hold. Everybody likes to redefine the current moment as a new moment in history. And for many reasons, the environment that we're in today will be a lot different to previous environments. But to say that those patterns, those return patterns of the past are things that can just be thrown out the window completely, I think is wrong. I mean, you still get back down to the nuts and bolts of investing, which is, you've got a choice: cash, bonds, equities. Where do you want to take some risk? Can you take some risk? And what's going to be your return expectation for it?
Your study showed that prior to 2007, the minimum returns for growth assets over the long term were 9.8%. Do you expect that this will continue in the future, or have things really changed since then?
Yeah, I think when you look at those long-term periods, once again, the returns, what has happened recently is important, but equally important is where your starting point is in terms of how you're defining returns. So, for example, if you're looking at a 10-year return now, we're talking about starting from 1999 when markets were at an all-time high. So, the 10-year return figure is clearly going to look flatter because you're starting from a reasonably high point. what you're going to see now is we've had, these last 2 years have been probably one of the biggest drawdown in superannuation returns, and they're going to continue to impact the long-term returns that we see being posted. But when you look at those long-term returns, particularly over inflation, they've been very healthy returns. So in a way, what you're going to see is those numbers probably pulling back a little bit, but towards some more reasonable figures. But real returns of 5% or more per annum is what is in the system still today. Now, if you can get that and lock it away, that's a great outcome. To do that, you clearly need to be invested for a while. And what we're saying is, those figures probably going to stay there and maybe come back a little bit. But I think the return expectation and the ability to earn returns over inflation is still there.
As for recently launched the tax-adjusted benchmark for Australian super fund returns, now that's a topic close to your heart. Can you explain why? Oh,
look, tax is important. It's one of the biggest costs that come out of your retirement savings. And importantly, the returns that I'm looking at in this long-term return study are after tax that's been in place on super funds since 88. But coming back to that idea of the measurement of after-tax returns, it's all about making fund managers behave better in the way they manage your money. We're not, people pay tax when you make money. So there's no question, there's going to be tax that needs to be paid through this system. But things like, do you always realise capital gains as quickly, or the realisation of capital gains is something that can potentially be slowed down and the overall level of tax sort of reduced. I think putting a yardstick out there saying, hey, we're actually looking at what happens on an after-tax basis will mean that as an industry we can adopt better behaviours that reduces the overall level of tax being paid through better management of the portfolios. And that's clearly going to put more money into the hands of investors.
Thanks so much for joining us, Anthony.
Pleasure, Julia.